Turning to business now with Giles Beckford, our business editor. So, Giles, all eyes on Fletcher Building today.
Indeed, good evening to you, Sharon. Yes, there is no other story in town. It is the Valentine's Day massacre of the company sector, and quite basically, it's worse than I think most people had feared. Some thought that there might be another $200–300 million worth of bad debts and losses out there, but to come in with $660 million has just bowled over most people. The fact is, though, of course, that the strength, the size of Fletcher Building is probably what saved it. A lesser company would have gone to the wall with these sorts of losses, but the sheer size and scope and breadth of the Fletcher Building, the residential side, the fact it's got quarries, it does roads, it builds houses, it makes steel, it does formica and laminates, a whole pile of building products, placemakers chain. That's what saved it. That's what's made the bankers willing to stand by it, to forgive it the breaches of those banking agreements that they have in place, although they may be pretty hard-nosed as they renegotiate those, which they're hoping to do by the end of next month. This is not the end of it, although Mr. Taylor, Ross Taylor, the chief executive, is confident that they've found all the bad news, but this will reverberate through the company for quite some time, and it will show its way through, for instance, probably higher debt servicing costs, more stringent lending conditions from those banks and other lenders. It may well be that the company, as it looks at its business, decides that in the end it probably doesn't need some parts of it, so we may see some asset sales, although they've sort of tried to rule that out so far. And following on from that, of course, for shareholders, they've missed out on the interim dividend that would have been declared next week at the half-year announcement, and there's a good prospect that, in fact, that the company may want to save cash and therefore it won't pay out a full-year dividend in August. We'll have to wait and see on that one. Quite clearly, there is a damage to the Fletcher Building reputation, and its decision to not pursue any more big project work. They are a vertical construction company, which means that they do everything from go to woe, from top to bottom, and that's been its problem. Its decision not to pursue any more work in that area may have ramifications for the building sector in this country. It may mean that if they're out of the picture, the pressure will fall on lesser companies, or we may see some new foreign companies come into the market to try and snap up work there. But inevitably, it is likely to lead to higher building costs on projects, and that will have ramifications flowing through the system. So lots of things to go under the bridge, lots of ramifications still to be felt, and I think that we'll be talking about Fletcher Building and the trouble it's had today for quite some time to come.
And Giles, its share price took quite a hammering today, didn't it? And did that have an overall effect on the market?
Oh, it just slammed the market. I mean, there's close to $98 million worth of Fletcher Building shares have changed hands today. Just a slight amendment, some late trading that went through has meant that the final price fall was 72 cents at $7.05. Now, the turnover, as I say, $98 million for the day. That meant that the top 50 index fell by 63 points. That's about 0.8% to 8,059, and that was about half the share market's turnover. But on that point of view, yeah, I mean, the Fletcher Challenge, sorry, I keep saying Fletcher Challenge, that shows you how long I've been around. The Fletcher Building shares are actually back at levels they were a couple of years ago, and it's been a continuing story where they've been warning people of losses and bad news to come, and unfortunately delivering on them from that point of view. So the market has been hurt, but it will recover, it will bounce back. And looking at the currency, we'll just say, Sharon, a survey of inflation expectations, they perked up a little bit. So that just buoyed expectations that perhaps rate rises will be coming from the Reserve Bank at some stage next year, with the Kiwi ending the day at 73.2 US cents and 92.8 Australian.
Giles Beckford, thank you very much for your time.